Hello, welcome again to my videos. And in this video today we will discuss how to make money in the stock market. And this is actually a question that everybody asks, and everybody who wants to be an investor asks this question: how to make money in the stock market and how not to lose money. And actually, it's the fear of losing the fear of losing money is is actually stronger than the need to make money. So we will discuss how to make money in the stock market. The first thing is that the easiest way to make money in the stock market is buy a few stocks and then sit tight. And if you take this simplest and the easiest way, you should be able to you should hope to make around 10 times or 5 times the money that you invest initially, that you put up initially. But the point is that if you buy and sit like this, you may have to wait for some 15 to 20 years. And it's not impossible. It is also possible that you may have to sit for around 30 years. And after 30 years, if you start investing at the age of 20, and if you remain invested for 30 years, you will be 50. So you have to wait that long to enjoy the fruits of your investment. So this is the problem with buying a few shares and then sitting tight. So if you are a bit adventurous and if you are willing to take some risks, then then we have another option. The stock market actually has another option. You could go into margin trading. Now, what is margin trading? In margin trading, you don't have to buy all the shares that you want to buy. Okay, and margin trading happens for a single day. In the morning, okay, let's take a situation like this. Suppose when the market's opened, the share of Reliance is selling for 51 rupees. Okay, and you have seen that there are some indicators, that these indicators have told you that the market is likely to go up during the day. So what do? You buy 100 shares of 10,000 shares of the Reliance share, which is 51,000 into 51 into 10,000, that is 5,10,000 rupees. But when you go into margin trading, you don't have to put up all the money. Depending on the brokerage, depending on which company your depository participant is, you may have to put up around 25% or even 10% of the amount that you will need to pay to buy 10,000 shares at the rate of 51 of that particular company. But in this case, you are providing only 25%. So out of 5,10,000, you are going to put up only 125 plus 500, 125,000, 1,25,000, something like that, 1,25,000. So after you buy the shares, it has now become, you cannot keep the shares for more than a day. If you want to keep the shares for more than a day, you have to supply the rest of the money and square off at the end of the day. Square off means you have to buy all the shares if you want to have them. So instead of buying, what do you do? If the shares rise in prices and they become 54, when you bought in the morning it was 51, and at the end of the day they have gone up to 54. So what do? You would sell all the shares, even though you do not own them. You can sell the shares. Okay, you can sell all the 10,000 shares. You have bought all the 10,000 shares. You have actually told the stock market, told the owner of the shares that I will buy your shares. I have bought your shares and I have paid you 51,000 rupees as the premium. So that is why he will wait until the end of the day. Okay, and at the end of the day, if the shares go up, they go to 54,000, they go to 54 from 51, you will make a cut of 3000 rupees. You will make a profit of 3000 rupees per you will make a profit of rupees 3 per share. So you bought 10,000 rupees in the morning, so you make a profit of 30,000 rupees at the end of the day. This is called margin trading. You buy shares but you don't own all of them, and then you sell them even though you do not own any of the shares. And in this manner you can make some money in the stock market, quick profits in the stock market. But the point is that you should be able to predict the market fairly well, and if instead of going up the share market goes down, suppose it was 51 in the morning and at the end of the day it comes down to 48, you have made a loss of rupees 3 per share. And since you bought 10,000 shares, you will make a loss of rupees 30,000. So initially you put up 50,000 rupees, and at the end of the day, after making a loss, you will have to come up with the 30,000 rupees extra. So this is the problem with margin trading, but it can give you good profits if the wins are in your favor. So in a similar manner, instead of buying in the morning and selling in the afternoon, you could sell in the morning and buy in the afternoon. Now when do you do this? You do this when you think that the market will go down, okay, and you have got some indicators that the market will go down. So in this situation, you will in the morning, even though you do not own them, you sell 10,000 shares at the rate of 51 per share, and at the end of the day you buy them back at the rate of 48 per share, 10,000 shares. So in this situation also you have made a profit of 30,000 rupees. So this is another way of making profits in the stock market. The third way is to go into option trading. When you do option trading, you pay a premium to the owner of the shares and then tell them to wait until a particular date. You can buy put options, you can buy call options. Now we will discuss these in a subsequent video. So let's wait for that video. Thank you very much.